All right, good morning, everybody. The war continues, and the war is going to be the thing that continues to push the market randomly from one direction to another. It seems like every major institution and all of the big prop firms are all waiting for the announcement that this war is done. And if you think about the way the market reacts to events, this war has become, I don't want to take away from all of the pain and the suffering and the things that are going on, but it's become boring. The market no longer cares. They need this. They're going to start focusing on something else. If you think about it, when there was any major crisis in the world, it doesn't take very long before the market gets tired of looking at that one thing, gets tired of the over vigilance. There's the word, vigilance, and it moves on. So, I sitting here watching Finance Juice, and it is nonstop red alerts about the Ukraine. There's a damaged nuclear power plant again. There are now damaged underground gas tanks. They are in their new round of uh, meetings and negotiations, suing for peace. So that's going to stay on the forefront. It's going to continue to push the markets around. It's hard to trade that way, right? I continue to hear from people that say they have no trust in the market. They get their small trades and get out. I'd say continue to do that and don't try to adjust your strategy. Get your small trades and get out. Don't try to stick this thing all day long, because any random news can come in and push the market against you just enough to stop you out. It is an FOMC week, and that means there is a serious lack of participation normally. I'm going to stick to my original assessment. And when it comes to FOMC, people have an opinion. Everybody has an opinion. I'm going to stick with the idea that the market really priced in an aggressive, hawkish Fed. And now they're going to unwind that when they realize the Fed wasn't so hawkish after all. And if you're not used to the phrases or the terminology, they basically priced in an aggressive Fed coming in and making drastic and severe, shock and awe changes to policy. And that's not what they're going to get. The negative turns we saw in the market to the downside before this whole Ukraine thing piled on to that negative market, those negative moves were just pricing in that new policy. So the expectation is that they're going to come out, present us with a less aggressive federal policy, and the market will buoy up off of that economic news. Now, whether it sticks, whether that becomes the thing that gets us back up to previous highs, I doubt it, right? There's just too many companies that are being hurt right now from this whole Ukraine crisis that are going to fail to adequately grow their earnings. And that's the market. I mean, if you haven't figured that out yet, it all comes down to a company's ability to continue to grow, right? So I would not be surprised if we end the week high, a lot higher, maybe near the upper edge of the weekly expected move, or even beyond that. Whether or not it sticks, or we'll deal with that next week. But for the week, you're very likely going to see a lot of range-bound markets. When we get to the charts, I'm going to point the range out. It's very likely that we're going to stick. We've got that critical low that has been put in a few weeks back. We're unlikely to challenge or break that without some sort of news out of the Ukraine. And the market is just going to be waiting for this announcement, right? And I'm not saying that we can't trade. We absolutely can trade. Just keep in mind that the market is a very correlated place. So if S&P and SPY are doing nothing, then 80% of the market is going to do nothing. It's going to be those sideways days, and the days are really wide right now because of volatility. So those sideways days can be really big sideways days. Plenty of room to move and to make money and to have some great trades. All right, we got that babble out of the way. The dollar looks like it's going to break $100 this week. Been a while since we sustained a move above that, but it's in focus. We keep our eye on it today. Go to Thinkorswim, bring up Market Watch, bring your description next to your time, makes it easier to see. If you've got a really cluttered calendar in your Market Watch, maybe something that looks like this, it's just all cluttered, hit the show all and turn everything off. And once you do that, just come back in and hit Econo Day event, then drag your description over so that your time is right next to your event. 11:30 today, additional auctions. I'm going to continue to stress this until it becomes normal to everybody. Those auctions are where this market can absolutely change the course of the day. We can be sideways and suddenly start running to the upside or downside. We could have been trending all day long, and this can just shut a trend down. Also, during lunch, we don't expect the market to make really big moves. We don't expect breakouts. We don't expect, a change in course, except on days where we have additional auctions. Sorry, I just seen some news coming through the finance juice. I'd say the market did not like that. All right, for today. We had a pretty decent open last night. Gap to the upside. We closed the gap, so it's done. We don't have to worry about it. And we've been maintaining above it. This isn't the low that we have to worry about, but for the moment, it's the universal pivot point that we want to focus on. When we've gapped up in the overnight hours, it's often natural to see a market reset that low before doing anything else. So even though it's already been reset, it's basically happened in the overnight hours. We could see it again. Otherwise, we're going to look to yesterday to give us some guidance and some news. There could still be some liquidity from around that 1 o'clock time frame. We've hit that area, but we haven't made it all the way through. So it kind of implies that the next time we get up there, we're still going to have to battle through some liquidity. Then we've got yesterday to deal with. $42.75, yesterday's open. And 42.56 was Friday's Globex open. So more universal pivot points to deal with. I don't expect it, but you could mark out 4,300 or 4,311. Definitely 4,311. It's a cog line. But that's a little too far out of our range unless this market does get some sort of news from the Ukraine. We've got an ADR right now of 2.7, and we're not even up a half of a percent. So plenty of room to make that move to the upside. But we've already gone through 12 hours so far, right? So you'd be looking at 0.75% just to get back up to our Globex high, and another 1.5% to get us up to yesterday's open. We can do it, but it's unlikely to we're going to make a move like that without a catalyst to take us there. So this is very likely going to be our day. On range bound days like this, your oscillators are going to do better. So things like the stochastics, for an example, will do good. And for a visual on the charts, since the stochastics is a lower indicator, something like the Keltner channel would work good. The reason I mentioned the Keltner over something like the Bollinger will expand really wide and then take forever for those bands to come back in again, right? Whereas the Keltner is way more dynamic. It'll keep those bands relatively close. And you're looking for if you're looking for a breakout, then an expansion beyond the Keltners is a good signal to start with. It takes a lot of push to get the market to move that far that fast. And then it takes even more push to keep it outside of those bands, right? But on a range day, those bands become really nice reversal edges. It all comes down to standard deviation, and everything in the market runs on standard deviation, linear regression, mean reversion. Somebody asked if this is a failed flag. Well, it hasn't failed yet. We just are expecting it to fail because of how long the flag has gone on, right? This part back here, that would be the pole, and this part here would be the flag itself. The flag is beginning to extend as far as the pole extended time-wise. So it hasn't failed yet, but it's certainly lining up to be a fail since we expect flags to continue, and this has not yet continued. Again, it won't be subtle. If we were to break some levels today, it's going to come in hard and fast. You should be able to see, just like Friday, many different places that you can check to validate, is this still moving to the downside with conviction? Should I still be looking for a trade? Should I go with the move to the or against the move? All right, so we're looking at the volume profile in green and the time profile in blue. The blue one is TPO. If you go looking for it in your Thinkorswim, it's not a custom indicator, it's just TPO. Volume by time, and in green, volume by price. Neither one of these, because I keep getting asked about it, neither one of these are custom. They're just normal, everyday Thinkorswim indicators. If yours don't look like these, it's because you haven't set it up right. I did do videos or live streams in the futures room where I walked through what those settings are and how to make adjustments to them. So I would say go back and watch that video. We even titled it, so you should be able to find it. Should. We're outside the box and underneath it. So the expectation is that we come back in the box and we begin moving towards the point of control. That'd be the red line from the volume profile. I'm on a 10-day, 30-minute time frame. If you read Corey Rosenblum's book, you would understand why I chose this time frame. If not, then I will point you in that direction. I think he's got more than one book now, so I'm going to have to go back and get which title it was. That way you know which book. We used to be able to just say it was his book, but he's got more than one now. I'll get the title and get it posted. So the expectation is we're going to gravitate back towards the point of control. Although a moment right now, we're moving away from it. And that's a point of contention. You want to not just bring up something like this, but focus on what are we doing? Are we moving towards the point of control or away from the point of control? Is there any volume over our head that could act as a resistance? Is there a shallow area where we could move through it quickly? And there is overhead resistance until we get past the 4260 area. Then we get into a nice shallow spot as we get through 4300, and then the cog line right around that gravity point, 4311 ish. The author's name is Corey Rosenblum. So looking at the volume profiles on a day-to-day basis, you can see how we've got everything clustered up, which we already knew that, right? It's not much of a surprise, but there's no virgin points of control out here to contend with, right? There's no untouched point of control. So everything's just clustering. It's just wound up really, really tight. And this is very likely going to be our range for the week. So you're looking at 4311 down to 4111 would be more appropriate. I'm going to just stop it at around 40, the low, down at 4140. But that's very likely going to be our week until the Fed talks, right? Once he comes out chipping his teeth, it's fair game for where we go at that point. But until that time, we're very unlikely going to leave this range. Of course, we put the little asterisks in and say, the news can do a lot to this market. So, because of the Ukraine Russia, we could come out of this box. But I think that would literally be the only thing that would get us out of this box before FOMC. That also does mean you've got a muted iron condor and you've got targets for butterflies that are for today and Wednesday. We started putting some of those on Friday in the live stream. One of the reasons that we pick butterflies is they have a very, very high payout with a really, really, really cheap dividend with a debit, right? So we're talking two pennies, 3 pennies. If you don't understand the multiplier, that means $2 or $3. You can't go to McDonald's and get a coffee for $3. So if the trade doesn't work and you lose less money than your commissions, right? Your commissions are going to cost you more than that loss is going to cost you. For the Nasdaq, we just broke through a critical level while I was streaming. Before this stream, I do not believe we were underneath that level, but either way, we certainly are now. And we're going to now be focused on 13,100. That's not just the round number, it is the low from Tuesday's Globex, Monday night, Tuesday morning, that overnight time frame. I had a lot of people asking about Friday's price action and that move to the downside. One thing, we were able to validate through the day that there was no reversal, there was no rally, there was nothing telling you to go long Friday. But there also was a really low volume and not a lot of capitulation. There was nothing coming through in the VIX. And I don't know about you guys, but I wasn't really feeling the fear Friday, right? It was a very controlled, systematic move to the downside. Nice and easy, right? And that says a lot because that kind of puts in the idea that this market didn't even get shook up through that move. It did considered that move yesterday as just another day, just doing business as usual, no big deal. What's it going to take before this market starts to think that a move of that size is a big deal? Yesterday, we moved down 4.25%, and the market just shrugged and yawned. So a little bit of a heads up that the tools that we look at on a day-to-day basis provide that context. It's what we use them for. right? And there was no capitulation Friday. There was no fear in the market. There was nothing. It was just another day. It was just a boring, normal, slow, laid back day. And we moved that far. So imagine how much worse it's going to get if this market does decide that it's scared. So we're getting that move back up in the dollar, as I talked about. The US dollar above $100 is going to have ramifications across this marketplace. We've been there before, sure. It's not like it's not like we're getting into uncharted territory. We're also nearing the top of this multi-year level. Now, when it comes to the dollar, it's not just where we're at, it's the why behind it, right? And this is really important to grasp. When China was sanctioning its citizens, its rich civilians moved their capital out of the China market and brought them over and started getting into our market. Well, they need to convert to do that, right? So they were buying up the dollar so that they could buy into our market, and it made the dollar really bullish last year during that time frame when we seen that happening. So that strong dollar was a reflection of a bullish bias because they were coming in and buying our market. But there are other times where the dollar is a perfect reflection of what's going on fear wise around the world. So the dollar will mimic really, really close what the VIX is doing. So when we see the dollar move on its own, it doesn't give us enough information. We have to dig deeper and ask the why. Is it directly correlated or connected or paired with the VIX? And if it's not, then at least you have that starting point. And it's a real simple thing. Just bring the two charts up and look at them side by side. If they have identical charts, then they're moving in lockstep together, right? And we would need to get them decoupled again. They're not coupled right now, so we don't need to wait for them to decouple. But it's a simple comparison. Are they moving in lockstep together? Because if they are, then the VIX and the dollar are both representing fear and risk. The dollar's global perspective of risk, and the VIX would be our US market perspective of risk. Because if you think about it, when those institutions can't go to cash, they're going to go to something. And the phrase, it's not my phrase, but the phrase is our junk is better than somebody else's junk. Which dollar denomination are they going to get into? Well, they're not going to go to the ruble, right? And they're not going to go to the peso. So where are they going to go? They're going to put their money in the dollar. And that's why it becomes a symbol or a representation of global hedging or global risk. But that's not what we're seeing at the moment. It's what we want to watch for. We want to keep our eye on these two and make sure they don't correlate. So when they're not, you want to find a source that has some background on what's going on in the dollar. A lot of FX news sources are good for that. TD Ameritrade, Schwab, Fidelity, IBKR, they usually all have some post that talks about the dollar. You need more background than just looking at the candles, right? So I highly encourage you to find a source that can give you that depth or that background on what's going on in the dollar on a day-to-day basis. It's why we start every morning on FX Street. They usually give a little bit of source, a little bit of information to start the day. We're getting some moves in the bonds. And last thing on the dollar, if it gets above 100 and holds above 100 by the end of the day, we're very likely going to see some ramifications of that across the board. Now, we don't quite know what it's going to cause, right? But we definitely want to be keeping our eye on it, especially if the dollar begins to make erratic or drastic moves. All right, so we're looking at the bonds. We're on a 2-year chart. We've got a very large angular trend. We took that deflection last week. We're headed back down, challenging that 149.20 area. It's a significant line in the sand, and it's really hard to grasp that the bonds are going to continue this fade to the downside unless we get just a absolutely rip your face off rally in equities. And we know that we have no expectation of that before Wednesday. So keep your eye on the bonds. I'm looking at the 30-year, but you could, most definitely bring up the 2 or the 10. It'd be good to review all three of them through the day. Just kind of keep your eye on them. We don't want to see large exaggerated moves. All right, so we broke a critical low, or not a critical low, but we broke that Globex low last night, and we had a significant move. It kind of stabilized a little bit, and notice that there was not a reciprocating play in the ES during that move. If you kind of match your cursor for each of the charts, oil had the same break to the downside, but the VIX didn't respond, and the S&P didn't respond, and the Nasdaq didn't respond. The dollar certainly did, and gold responded. So for the Nasdaq, we could get back above that 13,400, but it's very likely that our range is set for the week, something like 13.8 down to 13,000. This is what we got for the week to work with. This is the SPX index. They called the low on all of the indexes. So 41.14, it's that structural low. They say the low is in. It's another way of saying the same thing, that the low is in. And unless the FOMC is completely off, or that my perspective of that event is completely off, the only thing that's going to take us back down to that structural low or through that low in the S&P would be something coming out of the Ukraine war. But we've been wound up sideways for multiple days in a row, and we're just building up more and more and more energy. Same thing with the NASDAQ. The low is in. That's very likely going to be our low. That's why I mentioned 13,000 rather than 13,100. And 13.8 gets us back to the top of this range. And that's very likely going to be the week, too, at least until the Fed talks. Now, the Russell's got this really nice balance zone, 1900 to 2100. And again, the low is in. Very likely not going to challenge that low without a catalyst to get us there. And the Dow. But notice we're getting a lot of compression. Lower highs, higher lows, just winding up tighter and tighter. This thing is ready and primed for a massive move. And there's no promise of direction here. The volume's a little light in the fangs this morning, and they're all negative. And keep your eye on the fangs through the day today. It's one of the tools that we use to kind of confirm or validate the moves that we're seeing through the day, like Friday. None of these were going counter to the trend on Friday. There was just one more piece of the puzzle to validate what it was that we were watching unfold and getting the confidence to take a trade with any conviction. You see the AD and the S&P Friday, it just followed the market perfect. Consistent, persistent move to the downside, never went against us. Same thing in the NASDAQ. We dropped below that 50% of the advancing issues, and it just continued to decline through the entire day. Systematic, consistent, persistent moves never went against us. Cumulative tick, same thing. A nice, clean, general move to the downside, never went against us. No spikes in the Russell, no signal of anything except good, clean, bearish price action through the whole day. And looking at the tick, we did spike back up above the zero line multiple times through the day. So a little bit of that crisscross back and forth, but predominantly staying below the zero line. So you had every sector, you had the fangs, the advancing issues in every market, you had the tick, everything pointing to a downward move in the market. The only thing that went against that bias on Friday and made people uncomfortable about trying to take a trade in there was that at any moment, literally at any point in time, we can continue to get some sort of news out of the Ukraine situation that can spike this market in the other direction. More and more institutions are cutting their year-end guidance. Um, Last year, they were projecting this year's end somewhere around 52, 5,300, and now they're talking 47, 4,800. If you're ever uncertain and you want to kind of get an idea of where the market is pricing in the end of the year, where they think the S&P is going to go or where it's going to be by the end of the year, just go take a look at the futures. They're called that for a reason. You can see that we're looking at July, September, October, November, January 23, all the way into 2024, all the way up to November of 2024. And if you want to see what it was, say last October, maybe I went a little too far back. This is where they were pricing us to be. It's where we were at, right? Now you can go in and kind of fiddle with it and actually set it to your series, which I believe is what I would have to do here if I wanted to get more specific with it. You got to go in and actually set which contract series you're looking at. But that would give you the perspective of where it was back then for their forward guidance versus where we are now and their forward guidance. So that's the year right here. Just 2022 and 1 year of 2023. That's what they're pricing into the market right now. Since we're here, may as well take a look at what's going on in the VIX. When it comes to time and price combined, we generally expect the slope to start at our lower left and go up to the upper right, and that would be contango. It's think of the word contango as just things are normal, right? They have to put a funny nerdy phrase on it to make people feel confused, but it basically just says things are normal, everything's fine. Things that are farther out in time are generally more expensive than things that are right now immediately in front of us because there's so much that could happen in the future that makes things more pricey out there. When we are no longer in contango, when we're no longer in a normal environment, and the things right now are more expensive than things farther out in time, then we're in backwardation. When you're looking at the VIX and you're thinking about backwardation, this basically says that the world is more fearful about the next 2 months than it is about what could happen near November, December, right? That our immediate market environment is where everybody is focused and it's where everybody is fearful of something that could happen. Now, I've heard the phrase said differently just to kind of get some context. Like people are pricing in that the world could end in the next 2 months as opposed to the world could end in the next 9 months. I don't really like that connotation, but it's been used before. Certainly not mine. The algos that trade the machines and the way that your options are priced are completely affected by this, 100% affected by this. So you'll always want to know, are we in contango or are we in backwardation? Because it affects everything everywhere. All right, so we're looking at the S&P 500. We want to adjust it to pre-market change percent. Use the filter, knock the names down to around 100 names. Just trying to get close. It doesn't have to be perfect. Adjust the color scheme. And we can see that a couple of the FANG names are beat down pretty hard this morning. And a few of them are flat, like Google and Microsoft. I was giving a lot of consideration to the idea that maybe Facebook shouldn't be a part of the FANG names anymore. I don't know what we would call it if we didn't have the F from Facebook, but yeah, valuation wise, it doesn't fit anymore. So I've been kind of adjusting the FANG chart, one with a Facebook and one without, kind of evaluate it for the next week or two, see if maybe kick that name off the list. The financials are getting a lot of love this morning. The Nasdaq 100 does not have financials and the S&P does. So very likely to see some sort of divergence between the S&P and the Nasdaq this morning. And then the retail side is looking, I mean, pretty good this morning. I'm really shocked on the Amazon outcome after that stock split announcement. It's something we've all been waiting on forever. Finally got it, and there's nothing. The market didn't care at all. Kind of goes back to what we were seeing on Friday. There's just nothing, which is a little scary when you think about it. So from the S&P, we jump over to the Nasdaq 100. We don't need a filter. Keep it on pre-market change percent. Just adjust the color. That risk off really stands out here. Tesla, Amazon, Apple, Microsoft, Facebook, Nvidia It's all of the fangs except Google, and Google's flat. So, I mean, it's right on the edge of being negative. That'd probably be a good place to target if Google just hasn't caught up to its peers yet. So, definitely one worth watching this morning. That thing can move, right? And those options price really well for a good day trade. So, names in the NASDAQ down at least a half of a percent, 20. That's not overly bearish. Names in the S&P down at least a half of a percent, 9. Now, when you're looking at those names, it's not one individual name, right? We want to approach it from the idea of, is there a sector that's really down this morning or really up? Is there an industry or a sub-industry that's really getting a lot of attention this morning? Is there a name missing from the list that could be behind the curve and needs to get caught up with its peers? For an example, I see Tesla on here. Every time I see Tesla, I think, where's NIO? Where is that thing? So it's not here yet. Is also our gauge for quantifying how bullish or how bearish are we this morning. Not very bearish at all. So flip it over and take it the other direction. How many names are up this morning? At least a half of a percent. In the NASDAQ, 12. Again, that's nothing. That is absolutely nothing. And the names that we're looking at, Pepsi, Walgreens, Ketchup, a whole lot of nothing. These names can't move this market. Same thing on the S&P. How many names are up at least a half of a percent? 34. Now we're getting somewhere. So 34 names are up at least a half of a percent. Wide ranging, lots of different sectors, lots of different subsectors. So general across the board, not one sector, not one industry. If we don't have the fangs, we're not coming up in any sort of rally. If we don't have tech and finance working together, then we won't get a phenomenal rally. And if we only get one or the other, then we could have a muted rally, or we could see a bifurcated market where the S&P kind of does nothing and the Nasdaq runs, or the S&P runs and the Nasdaq kind of does nothing. That's where that split market comes in. So I see a lot of defense in here, not a lot of risk on. So bringing it over and looking at the sectors that are up this morning, may be easier to start with what's down this morning. Natural gas, oil, silver, energy, bonds, gold, emerging markets. Tech slightly down. Then we get into a lot of flat names that aren't really up. They're just not really down. Cloud computing, marijuana. Then we start getting into the names that are positive. Utilities, building materials, durable goods, household goods, food, airlines, industrials, Bitcoin, and financials. So we can see some of the names in the crypto are up, but not very many. We have a couple of legacy names in the EV market that are up this morning. Ford being one of them, GM, kind of your old school car legacy names, but otherwise, the EV market isn't looking so hot this morning either. And it could be due to Tesla, or it could be due to XPEV, which is down over 9% this morning. Li Auto down 7, and NIO getting close to being down 4%. So some really big names heading to the downside this morning. So on a day like this, you're very likely not going to be able to lean on the sectors for your trade opportunities. These are the days where you want to use your own watch lists and scans. That Thinkorswim high-low graph is about the most amazing thing that I've ever seen when it comes to day trading without having some paid for service, right? Obviously, you get what you pay for if you go and buy something like black box stocks or Hammersmith. You're going to get that nonstop flow. But other than that, if you don't know how to code a scanner, then that high low graph is about as good as you can get. I've never seen anything even remotely close to it. And you don't have to code it, you don't have to do anything with it. So to get to that, load your watch list. We've been using the import from the CBOE website, the most liquid names traded in February. And then open up the customized screen and just type in high. You'll get high low graph. You don't have to adjust it, but you can. It's set at a default setting of daily, but you don't need to do anything. You can use it to day trade with it just like that. It goes from a -1 all the way up to a +1. It'll turn like a really bright orange in its most negative form and a really bright green or maybe a yellow in its most positive form. On an intraday basis, this thing is phenomenal. It will bring you trade ideas all day long, no matter what kind of market we're in. I have done videos on this and I did customize it a little bit. I built a scanner around it. That way we could scan, for an example, any company with weekly options. That's 600 companies or 600 entities because it also has, like ETFs in it. So we just run the scan and say anything that's got weekly options, we want to look at it. And we only want to look at things that have a high low greater than 0.9. Remember, it goes from a -1 all the way up to a 1. So if 1 is the highest, then 0.9 gets us really close into that higher edge. Of course, the market's not open, so it's very likely not going to pick anything up at this point, especially since I'm excluding all ETFs. But that's how you do it. Just set it to weekly. And like I said, I've shared this. The link for it is in the chat. So if you were to go to large caps and go to the search feature in the upper right corner, just type in the words high low. Yeah, it's a lot of stuff. Keep scrolling, you'll get to it. High low graph, scan import link, share link, and a video that went with it just to kind of explain to people what it is, how I learned about it, how I know what it does, right? Because I didn't create it. So we have to figure out like how the hell does the damn thing work? That way we know what settings to adjust. Well, I didn't pick it up from osmosis. I had to learn it somewhere. So I explain all that in the video, and then there's a share link to go with it. Yeah. Yeah, you like it. All right, everybody. Be careful. Be safe. Have a good morning. I will be streaming in the futures, so I'll see you all there.